Good morning, everyone, from wherever you're joining us today on this second day of the 2022 London School of Economics Africa Summit. My name is David Luke, and I'm a professor in practice here at the London School of Economics, Firoz Lalji Institute for Africa. I'm delighted to welcome our main speaker morning at this session on African agency in a globalized world, thinking about trade and investment. And that is Dr. Albert Zofak, Chief Economist at the Africa Department of the World Bank. I won't read Albert's bio, as this is available in the program, but I know that he has prepared an intervention and will be speaking for about 15 minutes. This will be followed by a brief Q&A with myself here as the moderator and engaging with Albert, and then I'll open the floor for your questions as well. So without further ado, Albert, welcome, and we look forward to hearing your presentation. You have the floor.
Thank you so much, David. It's a great pleasure to be here. It's an honor, in fact, to be addressing this Africa Summit at the LSE this morning. So let me share my screen and speak on Africa's agency. Let me just okay. Good. So, can you see my slides? Perfect.
Yes.
Good. So let me say, the theme of this session really, matches almost perfectly findings of two of our recent publications in my office. So I thought I'll share with you this morning, our own take on what Africa should do actually to claim its right place in the new global environment. We've launched this new book, Africa in the New Trade Environment, Market Access in Troubled Time, a book I just had the privilege to launch in Ghana, in Accra, Ghana last month. And in November of last year, we launched this other book on industrialization in sub-Saharan Africa. I thought these two books really address the question of this session because one is about trade, the other one is about investment. But both are actually discussing how Africa should actually trade or invest in a way that serves its purpose, in a way that actually serves its population, serves its interest. How can Africa trade or invest in a way that it creates jobs? Because essentially, the key variable here is job creation for African economies, as our countries need to create between 1 to 2 million jobs per month to keep up with the demography. So, my office has published in the past couple of years a number of other books. I just wanted to flash it here for you to download. You can actually access most of these books on the Open Knowledge repository. You can download this, and most of these answers, most of the things I'll be discussing here would be findings from those studies that we have been doing in my office. Let me leave you with 4 suggestions as to how we can actually boost Africa's agency in this new global environment. The first is that we clearly need a new trade policy in Africa, one that accounts for the fast-changing global trade environment. And these changes are formidable challenges, but they are also huge opportunities. The second message is that sub-Saharan African economies should strive to scale up their manufacturing supply capacity which is key to maximizing gains from preferential trade schemes and market access opportunities with traditional partners such as the US or the European Union. The third message is that policymakers in sub-Saharan Africa should think beyond these traditional approaches and traditional markets and strategically diversify trade with Asia, for example. And the last message is that we should deepen regional trade through physical integration, but also through facilitating business integration, tearing down non-tariff barriers and strengthening political cooperation. And the Africa Continental Free Trade Area can certainly be a platform for such a strategic shift. Now, let me go a little bit more in detail in discussing those, because claiming its right place in this new global environment is not just going to come easy. There will be huge challenges. And the first challenge is that Africa's initial conditions are extremely difficult. And this is what I call the 3-2-1 paradox. 3, because Africa is only 3% of global trade and roughly 3% of global GDP. And you can see it on this first slide, and first and second quadrants on this slide. The 2 is that Africa is only 2% of global export. And the 1 is that Africa is only 1% of global exports of manufacturers. And you can see it here on the third quadrant of this slide. These are terrible initial conditions, and these are terrible because it has been that way for a while, right? Africa, despite working hard, has not been able in value to increase its share of global trade or GDP. We are only 3% while we account for more than 17% of the global population. That, to me, is cause for concern, and things need to change. The second daunting challenge is that as Africa tries to really act to claim its share in global trade and investment, that environment is actually constantly changing and is fast changing. And one of the big changes that we have seen is what you have on this graph in the middle of this slide, which is trade has actually become more driven by global value chains. We've moved away from the traditional, classical and neoclassical economics teaching of trade. It's no longer products. We've been trading parts and shares. We've been trading, global trade has been driven by value chains. And that Africa has been integrating those value chains, but at a very, very different level. Africa has been integrating value chains forward, meaning that we are actually contributing to other countries' exports of finished products. Integration should be backward, basically, inputs to finished products, and that's what creates jobs. So that is important. Africa is actually integrated in this global value chain, but at the wrong level, at the wrong, chain. We are clearly, integrated in the wrong chain. And the other very important change that we have seen in this global environment has been the rise of Asia. As you can see on this right side, the share of global GDP that goes to Asia has been really increasing exponentially. It's the red line you see here. And that share has clearly surpassed the US and the EU. And from 2005 onward, when China got access to WTO, to now, that trend has been exponential. So at the same time, Africa's contribution, as you can see on this graph, has been completely flat. So what is making that environment even changing even faster is those emerging developments. The COVID-19 pandemic, for example, that has led to a complete stop in global value chains, that has really impacted trade in 2020. We've had in the past 2 years, trade tensions and protectionism sentiment rising between US and China. And we have also seen an acceleration in the fourth industrial revolution, where labor-saving technologies are threatening some activities. Well, we have a third challenge, which is extremely important, which is Africa remains the least integrated region. As you can see on this slide, physical integration remains a challenge. And just like, most of you would know, integration, even traveling across Africa for business is probably one of the most daunting challenges any person. And I do travel across Africa all the time, and I can tell you it's not easy. It's just not easy. So we have a serious issue, not only because the continent is fragmented. We have roughly the population of China or India, but in 54 countries. We also have small economies, right? It's therefore limited economies of scale. Half of the economies in Africa are less than $10 billion of GDP. In comparison, a country like Malaysia with 30 million people has a GDP of around $350 billion US. We have also landlockedness. Close to a third of our countries are actually landlocked. And then you have the colonial legacy, as you can see on this chart, on this map of Africa, where infrastructure was actually built for extractions. And those of you who read Asemoklu would understand that not only infrastructure, but also institutions were actually built for extractions, not for development. So you have that colonial legacy as well, and you have serious issues in terms of multiplicity of rules and borders and bureaucracy, red tape, and corruption that definitely make trade extremely difficult. And the most recent challenge is the one brought to us by invasion of Ukraine, which is already affecting trade in Africa and is likely to actually slow down our economic recovery for 2022. As you can see on this chart, a number of African countries are actually quite dependent on Russia and Ukraine for their import of food. And Africa as a whole imports between $35 and $40 billion of food every year. So even before the Ukraine crisis, COVID-19 actually led to an increase in food inflation in Africa. And that increase is just going to be exacerbated, as we are seeing in African capital these days, as the price of cereals and bread increase, but also price of energy and some other materials. But there is a good news here, which is Africa can still industrialize. The figure you see here is from a paper I did with my friend Gimke of Georgia State University, where we actually revisited Roderick's concept of deindustrialization to find out that basically Africa as a whole may not be may not be deindustrializing. In fact, Roderick's finding is actually only relevant for Southern Africa, driven by the South African economy. But the rest of Africa is still actually seeing an increase in employment share in manufacturing, and that increase is steady. So it is important to debunk some of these myths if Africa is to claim its right share in the global economy. Now, let me quickly discuss the three opportunities that I see in this new environment. And we believe for Africa's agency, we need to reevaluate and re-engineer trade with traditional partners, strategically diversify trade, and conquer new markets. Third, we need to be looking inward. We need to be deepening regional integration. So on the first opportunity, in our new book on market access in troubled times, we have actually evaluated all the relationship between Africa and US and Europe. And what you can see here is basically, access to the market through AGOA, or access to the European market through EBA. So for AGOA, as you can see on the right panel of this slide, number of countries have actually missed the opportunity to capitalize on access to the US market. You see here Cameroon, you see Eswatini that actually had a boom and bust, and the bust is clearly after the multi-fiber agreement. You see countries like Lesotho with growth and stagnation in the market access to the US. And the only positive experience, more recent one, has been Ethiopia, and hopefully the war would really end this manufacturing experience to continue. So Africa has actually not fully taken advantage of those trade preferential agreements, or some of these agreements have actually been biased to maintain Africa's economic structure. Basically, AGOA end up helping the US import more oil than import manufactured products. And EBA and other traditional trade agreements have actually tend to ossify Africa's economic structure to provide raw materials into the global trade. Diversifying trade away from those traditional markets, or deepening trade in those traditional markets, but also expanding to new ones, would definitely lead to address the issue of where is the fastest growing market in the world, and it is Asia today. And yes, we have seen a big rise in relationship in trade and investment relationship between Asia and Africa, but it's nowhere close to being enough. But more importantly, it is dangerously replicating the same structure of our trade, basically exporting raw materials to China, to Asia, and importing cheap manufactured goods. So it is important to rethink those, and it is probably crucial for Africa as a whole to start thinking in terms of negotiating a deep trade agreement with Asia to ensure that some of that access to that market leads to a diversification of our export, and Asia and its growing population, its growing middle class, can actually import more of Africa's niche products or manufactured product as well. So the Africa Continental Free Trade Area, we have done a clear and very analytical assessment of its potential. And our view is that it's going to be absolutely useful to Africa to deepen its integration. And by 2035, we believe this can actually lead to a 7% increase in GDP and lift 30 million people out of poverty, extreme poverty, and more than 60 million out of moderate poverty. And that is certainly the promise, and we definitely believe we should all work towards deepening trade integration in Africa. But what is quite clear from our study is that most of the gains of the Africa Continental Free Trade Area will not come from tariff reduction or tariff elimination. Most of the gains would come from, tearing down non-tariff barriers and really slimming our borders, because we have the thickest borders across the world. And let me end here by saying that when it comes to Africa's claiming its fair share in the global trade and investment, we all need to think in terms of how to leverage investment and trade for economic transformation and job creation in Africa. And our thinking around the question leads us to believe that we need to be investing in three big pillars. One is the technological transformation, which includes, of course, the digital, but also some analog innovations. Includes leapfrogging, but also technological adoption and upgrading. The second pillar is the sectoral transformation, the traditional, structural change discussion in development economics, which would definitely lead us to increase employment, but also, output share of manufacturing and, high productivity services in our economies. And that would definitely be important to, lead to structural transformation. And the pillar is the spatial transformation, where we definitely need to build more value chains, strengthen urban-rural linkages, and that certainly would have to, increase regional integration as well. Most of it is dependent of all, massive productivity growth. African agriculture would have to really grow its productivity, as productivity has been flat in African agriculture for quite a long time. And sustaining those three pillars are three foundations: investments in skills, investment in infrastructure, and we want to highlight two categories of infrastructure that will be key for the future of jobs in Africa. One is energy, and the second is digital infrastructure. And the third foundation for this framework is the reform of our institutions that clearly would include a stable macroeconomic framework, but also good governance and the absence of corruption in the business climate across African countries. So in conclusion, I would like to just say, we cannot be contented, we cannot be happy with a situation where Africa, despite having more than 17% of the population of the world, only commands less than 3% of global GDP, less than 3% of global export, less than 2% of, less than 3% of global trade, less than 2% of global export, and less than 1% of global export in manufacturing. This situation must change, and I think we can all contribute to it. Thank you.
Thank you very much, Albert. You've given a very comprehensive overview of these issues on African agency in a globalized world, thinking about trade and investment. Starting with your four key messages that a new trade policy is needed to respond to a fast changing global environment. Then your message on scaling up manufacturing, your message on trade with Asia, we'll come back to this, and your message on deepening intra-African trade. And of course, you've expanded this, you've gone into a lot of detail as to how, in fact, this could be done. So this is where the agency aspect comes to the fore. Before I open the floor for questions, let me also just mention that unfortunately our second speaker, Somachi Chris Asoluka of the Emelu Foundation, has had connectivity problems and so has not been able to join us. So which all the more means that Albert, you have the platform to yourself to elaborate on these issues, and I see some questions already coming in. But let me start with the first question, and that is that I know that you've done a lot of work on services, but somehow I did not get much from your presentation on services, although of course you did mention that when you think about manufacturing today and you think about value chains, you're really looking at what we now call trading tasks, and that of course embodies services. But I think for our audience, just give us a sense of the kind of work you're doing on services and your thinking on services.
David, thank you so much. No, you're absolutely right. In my presentation, I emphasize more the findings from our book on industrialization. But you know, the service aspect actually touches on both books as well. First is trading services. And trading services in Africa is one where we have actually been doing some work. Take tourism, for example, which is one of those, you know, on the where Africa is actually not meeting its potential. And what COVID has done, for example, has been to actually cause a huge damage to countries in Africa that were, you know, exporting more of tourism services, right? So you take our island countries like Cabo Verde, like Mauritius, like the Seychelles, they had the deepest recession in 2020. And we have been looking at these countries struggle to recover. So countries like, the Seychelles had more than 14% drop in their GDP in a year. Capo Verde, in a close range in terms of, collapse in GDP. So countries in Africa that only depend on, trading services, especially tourism, are as vulnerable as those depending on oil, basically, right? So the key message here is that, dependence on only one type of commodity, be it, service, is as, is equally bad because it carries the same volatility in growth. So that's the first thing. Now, in terms of investment, if you think in terms of FDI coming to our countries, most of the FDI coming to Africa is in extractive sectors. So the increase in FDI you see in Guinea, for example, where investment has been actually increasing, is essentially, if you take Senegal and you look at the increase, the bump in investment, it's all linked to the new oil and gas in discoveries. You take Ghana, most of our countries are actually attracting investment only in natural resources. And I think investment in services should actually be, as important. And that, the debate on industrialization has been, addressing this question as if Africa should actually leapfrog directly to services and skip the manufacturing stage, right? And there doesn't seem to be strong evidence that those services actually have the same characteristics as manufacturing when it comes to productive job, when it comes to economies of scale, when it comes to, unconditional or conditional convergence, by the way, right? Manufacturing is the only sector that actually leads to faster convergence, than those services as well. So I think it's important to discuss services, and my colleagues and I at the World Bank have been doing a lot of work on trading services, but also investment in services. But it's clear that in countries in Africa where there is still a potential manufacturing, we should not, skip that stage. Thanks.
No, thanks for that Albert. That clarifies that issue very well. A second issue I'd like to raise before turning to the questions that are coming in, and which, by the way, are very appreciative of your talk this morning. But the second issue I'd like to raise is also an area where I know you and your colleagues are working on, and that is informal cross-border trade, or what I think at the World Bank you call small-scale cross-border trade. We know that this is where you find the poorest people in Africa engaging in trade across borders. What's your thinking on what can be done to grow this trade, to formalize this trade, and to overcome many of the border-related issues? You already talked about the thickness of borders and so on, that the most important impact from the AfCFTA would actually come from dealing with those sorts of problems. But again, just to hear your thoughts on this before we turn to the questions from the audience.
No, that's a great question, David. But look, we've done extensive work on the small barriers, right? And I think it's an important question because if you take the border between DRC and Uganda, or DRC and Rwanda, or all those countries, you have the poorest segments of our population that are engaged in what I call survival trade, and seeing how that survival, it's actually again prevented by those informal or formal barriers. The informal barrier here being the corruption. If you go to that borders, and my colleagues have actually been doing those surveys, and how many times those eggs across borders have to pay bribes before they get to those markets, right? That's the informal part of it. But the formal is in some of these of the countries being in regional blocks that should actually be integrated areas, still have those checks and those controls at the borders that really reduce the potential for these small traders to scale up their activities, earn more revenue to really to feed their families. I think that's a serious issue. But one of the ways I've addressed the question is, as with the barriers, we should not forget to continue focusing on market access. Because ultimately, David, it's not that informal trade that will develop Africa. It is the capacity of Africa to actually export high-value products to the world and export it within Africa that would create prosperity. I don't know of any country that has actually developed with the informal sector. I don't know of any country that has developed by just making sure people survive either through subsistence agriculture or basic trading that essentially keeps them below the poverty line. That's not development. That's survival.
Thank you for that, Albert. I think we can agree with you on this, both to deal with the inclusive aspect, but really to focus on economic transformation. Now, as I said, the questions coming in are very appreciative of all that you have said. I'm going to take them randomly. I have Hannah Getachew, who is saying, thank you, Dr. Albert Zolak, for your illuminating presentation. May I please ask for your insights on the degree to which the AfCFTA can facilitate trading goods and services of climate-compatible products?
That's an excellent one. Last October, my colleagues and I, in our semi-annual production that we call the Africa's Pulse, and I strongly encourage you to read it if you want to stay abreast with what is happening on the macroeconomic scene in Africa. In our October edition of the Africa's Pulse, we actually had this special topic on climate change adaptation. And it was important to focus on adaptation because, as all of you know, Africa is, responsible for less than 4% of global emission, but Africa bears all the pain of climate change through, an increase in an increase in frequency of extreme events. Last month I was in Madagascar. The country has actually faced 3 to 4 cyclones in the past 6 months, and that's linked to climate change. Think of droughts in Somalia, in Kenya, in Ethiopia affecting agriculture. Think of the Sahel, where is actually shrinking forests, but also shrinking waterways, like the Lake Chad that has lost probably 90% of its water in the past 60 years, affecting all populations' livelihood around it. So climate change, think of the rising sea level and coastal erosion in West Africa. Africa is suffering from climate change. So our focus shouldn't be that much on mitigation, because actually our impact on mitigation is important. If you exclude South Africa, Africa is actually less than 1% of global emission. So, if you think of it, the focus of Africa, again, as we speak of agency, we should first define what is in the interest, right? So, and what is in the interest of Africa in the climate discussion is, how do we adapt to this situation that we did not create? And how do we hold accountable those who have created that situation to ensure we adapt to it? Instead of flipping the discussion as to asking Africa to, just concentrate on mitigation as if we were the source of 90% of the pollution in the world. So I think we focus on climate change adaptation. And if you focus on adaptation well enough, then you realize climate change can actually be an opportunity. Climate change can be an opportunity for jobs, can be an opportunity for structural transformation. Why? Because luckily, Africa is also home to most of the resources that will be useful for the production of green goods. Think of cobalt, right? We're home to more than 60 or 70% of global production of cobalt, right? And DRC is certainly at the heart of that production. Can we think of a value chain around cobalt? Why is it that Africa, in its integration dynamics, wouldn't think of actually building that value chain of producing batteries for the green economy, right? Since we have the raw material, can we actually think of really building value chains around minerals that would be useful to the green economy? I call them green minerals, right? So, copper, you have cobalt, you have a number of those that would be useful for that carbon-free economy. And Africa can actually really, supply those to itself, and definitely move away from the traditional trade path, which is digging and selling, but transform it and create jobs along the way. And the Africa Continental Free Trade Area can be a great platform for that. Thanks. You're muted, David.
I was saying, yes, indeed. I was saying thank you very much for that, Albert. I'm going to take 2 questions because they're similar, and sort of read both out to you. The first is from Nur Lakhdar Tumi, who is asking, growth in productivity has left the region lagging behind many developing countries. How can we boost worker output? And do you think that redirecting direct resources to the most productive firms will be a solution? And then the second question, which is from Margaret Sunday, as I say, similar. We talk about potential for Africa to scale up in manufacturing, but what will it actually take? Why aren't we there yet? You can see that these are students who are thinking.
Oh, these are, well, I'm at the LSE. What do you expect, right? So, this is fantastic. Look, no, your question relates to the issue of resource misallocation in our economies. And my colleagues and I have another book coming out soon on Africa's productivity, boosting Africa's productivity. And we do have a big focus on resource misallocation. Because your question is actually touching on a very, very important point, which is, why is it that most of the African people are stuck in low productivity activities? What we see, what leads to increase in productivity is generally that resource movement from lower to higher productivity activities. That can come through structural change, where you actually have manufacturing, which generally is more productive than subsistence agriculture, absorbing excess labor from agriculture. And that you have a kind of automatic increase in productivity because of resource reallocation. The problem is that hasn't happened in most of our countries. My colleagues and I believe the reason is that we have not invested enough in our cities, not in agriculture. One, when you look at public agriculture in Africa, it's not that low actually. Is the spending composition of spending composition on agriculture that is the problem. We have found that most of public expenditure in agriculture in Africa is in subsidies, not in infrastructure, not in rural roads, not in what could link those farmers to markets. So that's one. So the issue is probably of, again, resource misallocation in agriculture. Second, our cities are clearly not moving in the direction of being able to absorb that potential excess labor more productively. We have a book on African cities, Opening Doors. That's the title. You can download it from our website as well. And what we find is African cities, because of the lack of infrastructure, the lack of connectivity, because of congestion, are actually very expensive. African cities are not allowing firms to operate in a very competitive way. So it is important as we think of productivity growth, and I agree with Noor, is productivity growth. But that productivity growth that needs to go from agriculture up to services, to informal services, that productivity is certainly stifled by the lack of infrastructure, the lack of right investment. I'll end with a little positive news here, which is we're currently working on a book on digitalization in Africa. And what we are noticing is the digital in Africa is playing a very different role from what it has played in other advanced economies. Labor is actually creating labor. It's boosting productivity, including of the informal sector. So stay tuned for that. I think that's a very positive development. And the question of Margaret, I think, comes to what I just developed. The reason why we haven't industrialized so far is simple. We have set ourselves in a trade policy that has mimicked the colonial system of African countries just exporting raw materials to others and in the process exporting jobs, right? Exporting jobs instead of at home. We have not invested properly in our agriculture to modernize it, to get innovation to penetrate agriculture and boost its productivity. We've not invested neither in our cities. That's certainly what we believe should change. Thanks.
Thank you, Albert. Our time is almost up, but I think we could do a couple more questions. We have a question on the Ukrainian crisis. Do you think that African countries will, what do you think African countries should do to react to the inflationary problems that are arising? And then another question, how can we make sure that women equally benefit from increased trade and investment? So I think we could end with those two questions. Back to you, Albert.
Thank you very much, David. Look, the Ukraine crisis, as I shared in the presentation, is already affecting our countries through trade. Let's so through investment, because the share of Russian or Ukraine investment in Africa is actually very, very low. But trade is actually quite important. The trade channel is through, it's exactly how this crisis is affecting our economies, especially raising food prices, right? And a number of African countries are dependent on wheat for their daily consumption. But I'm going to be provocative here, David. I've spent more than 10 years living in Southeast Asia, working on these countries in Southeast Asia. None of these countries actually have breakfast with something they don't produce. It's quite striking when you travel in Africa to see people depending on imports for their breakfast. That has always bothered me. I mean, why can't we really substitute that are being imported by grains produced in Africa? Why can't we raise productivity in Africa to actually get the grains that are needed? Expand trade within African countries, not close it, right? Don't ban export of grain, please, right? Use the Africa Continental Free Trade Area as a platform to boost productivity in agriculture and expand trade of grain, of food across Africa to solve the problem. Until when are we going to sit and wait for those to destroy our economies and put our people to hunger? So that would be my reaction. And women should be at the center of what we do. And at the World Bank, one of the pillars of our strategy at the Africa region is women empowerment. And women empowerment here is through the prism of economic empowerment. So, if you look at, trade in Africa within our countries, or even investment at a small scale, the good news is African women, especially, are more likely to be entrepreneurs than men. We have that finding. The only issue is African women are less productive than those led by men, which probably captures all the barriers and all the bias against in our economies. So we need to address those bias to allow our firms led by women to be as productive as other firms, if not more. We believe, if we increase access to finance to women, but most importantly, focus on education. Educating girls in Africa has a huge potential to boost productivity, but also to affect fertility and affect economic growth. So, I just chaired a seminar last week with Nobel Prize winner Esther Duflo, who has a paper on secondary education, the impact of secondary education in Ghana. And what that paper is showing is the return to educating women in Africa is huge, especially when you account for the impact on the next generation. Kids of educated women in Africa are more likely to be educated, more healthy. They are certainly going to have lifelong earnings that are higher than those of non-educated women. I think gender should be at the center of what we do, absolutely, not only in trade, but also in anything we do in development. Thank you.
Thank you very much, Albert. We could easily go on for another hour, without any question. But I think you have covered these issues of African agency in trade investment in a very comprehensive way in the short time. I think you've gone to the heart of the issues. I think, whilst it will be difficult to summarize, but nonetheless, your challenge of responding to the 3-2-1 paradox is one of my big takeaways. The 3% share of global trade and global GDP, 2% share of global exports, and 1% share of global exports of manufacturers. I think this summarizes and captures, in a sense, all what you have been saying and where African agency is needed to respond to this challenge. So thank you very much indeed for taking the time, and back to the students for the next part of the program. But thank you so much, Albert.
Thank you so much, David, and really thank you to the students of LSE for inviting me. It was a great pleasure and privilege to address you this morning. Thanks.